Every week, millions open investing apps and tap buy, stocks, crypto, meme ETFs, thinking they're investing. But without a system, it's no different than walking into a casino and calling it research. You don't need to be a genius to get rich. But here's the harsh truth. If you're investing without a system, you're not building, you're gambling. You throw money into stocks and call it investing. But without a plan, system, or understanding of risk, you're not investing, you're gambling. Hot take. Wealth doesn't come from guessing right once. It stems from using a structure the wealthy have mastered for decades, one that lets time and tax laws do the heavy lifting. Stick around, because by the end of this video, you'll know. The simple moves that can literally double your investment money without investing a cent more. The 5 pillars that separate gamblers from wealth builders. And the mindset that keeps ordinary people poor while the disciplined get rich quietly. But first, let's start where most people leave thousands of dollars on the table, your workplace. Hey Insider, welcome back to the Financial Freedom Insider, where we decode how money really works and hand you the systems the rich don't talk about. If you've been following us, you've already learned how to shield yourself with an emergency fund, how to cut the chains of debt, and now it's time to make your money fight for you. This is Investing 101. The foundation that keeps you from becoming another market casualty. The free money nobody talks about. Let's start with something most people completely overlook. Free money. Yep, you heard that right. Free money that's probably sitting right in front of you. It's called the employer match, and it's one of the easiest ways to grow your wealth. If your job offers a 401k match, a workplace pension, or any kind of contribution match, and you're not taking full advantage of it, you're literally turning down free cash. Fidelity reports the average 401k match in the US is around 4.7% of your salary. In the UK, the average employer contribution sits at a minimum of 3%, according to gov.uk. That means if you make $60,000 a year and skip the match, you're leaving roughly $2,800 on the table. Every single year. Skipping that? That's like leaving a $2,800 tip for your boss. Brilliant move. Do that for a decade, and that's $28,000 gone. Plus, all the growth you missed out on from compounding. And if you're self-employed or outside the US, the logic still applies. Whether it's a SIPP or ISA in the UK, or an RRSP or TFSA in Canada, these are all tax-advantaged accounts designed to give your investments a boost. They let your money grow tax-free or tax-deferred, so more of your profits stay in your pocket, quietly compounding year after year. I once spoke with a nurse who thought investing just meant buying stocks on an app. Then she found out her hospital matched 5% of whatever she contributed to her retirement plan. She started maxing it out, and 10 years later, her employer had added over $30,000 to her retirement fund. That's $30,000 of free, compounding fuel that she didn't have to lift a finger for. Once you've secured your free money, the next step is figuring out where that money should actually go. Because not every investment is truly an investment. What investing really is. Let's clear something up right now. Investing means buying ownership. When you invest, you're doing one of two things. You're either owning something that creates value, like shares in real companies building real products, or you're lending money to people or institutions who create value. That's what bonds are. That's it. That's the foundation of every investment on Earth. And here's the mindset shift that changes everything. The goal isn't prediction, it's participation. You're not trying to outguess the market. You're taking a seat at the table of human progress. Innovation, labor, creativity, all compounding and working in your favor over time. Benjamin Graham, the father of value investing, said it best. The investor's biggest problem, and often his worst enemy, is himself. That means your emotions, your impatience, your fear. They're usually the biggest threat to your returns. In 2003, Apple's stock traded at around $1 per share, adjusted for splits. A $1,000 investment back then would be worth over $200,000 today. Not because someone predicted the future, but because they owned innovation and stayed invested. So if investing is about owning pieces of progress, what stops people from getting started? It's not money, it's myths. And these myths quietly destroy more wealth than bad investments ever will. Investing myths that keep people broke. Myth number 1. You need a lot of money to start. Reality. You can start with $50 or less. Platforms like Fidelity and Vanguard allow fractional shares. Consistency beats size. Myth number 2. You can beat the market if you're smart enough. Fact. Spiva data shows over 90% of active fund managers underperform the index over 15 years. If the pros can't do it consistently, neither can your neighbor with Reddit tips. Myth number 3. Investing is too risky. Reality. Not investing is riskier. Inflation quietly steals your money every year. Historically, equities have outpaced inflation by approximately 6 to 7% annually. Myth number 4. You need to understand everything before you start. False. You learn by doing. Start small, automate it, and watch your confidence compound along with your money. Myth number 5. It's too late for me. Even starting at 40 gives you 25 years of compounding power. ARP found late savers can still build comfortable retirements by maxing tax-advantaged accounts and staying consistent. Once you drop those myths, the fog clears. And what's left are the timeless rules that actually build wealth, the kind the rich never break. The 5 pillars of smart investing. All right, now that you know what investing really is, let's talk about how to do it the smart way. These are the 5 pillars that separate people who build wealth from people who just hope they will. Number 1. Diversification. Don't bet on one horse, even if it looks like a winner. Diversification means spreading your risk across different companies, industries, and even countries. Jack Bogle, the founder of Vanguard, called index funds the ultimate diversifier. Why? Because with just one click, you can own a tiny slice of thousands of companies, all working to grow your money. Think of it like this. One company can fail. 1,000? Much harder. Number 2. Low costs. Fees are the silent killer of investing returns. A 1% management fee might sound small, but over 40 years, it can eat up almost 30% of your total gains, according to FINRA. That's money that should have been compounding for you, not your fund manager. So go for low-cost index funds or ETFs, because keeping your costs low is one of the easiest ways to guarantee you keep more of your profits. Number 3. Consistency. Here's a secret. It's not the smartest investor who wins. It's the most consistent. You can't time the market. Nobody can. Research by Dalbar shows the average investor underperforms the market by about 6% per year, all because they panic, sell low, and buy back high. The fix? Set a schedule. Invest regularly. Rain or shine, headlines or hype. Keep going. Because consistency beats emotion. Every time. And every dollar you invest is a worker you send out to build your freedom. Number 4. Stay invested. Here's a stat that might shock you. If you miss just the 10 best days in the stock market over the last 20 years, your returns could be cut in half. That's straight from JP Morgan Asset Management. Timing the market is a myth. Time in the market. That's where wealth is built. So stop trying to jump in and out. Stay invested. Let compounding do its thing. Number 5. Rebalance and review. Even the best portfolio drifts off course over time. Some assets grow faster, others lag behind. And suddenly, your risk level isn't what you planned. That's why rebalancing once a year is key. It's not trading, it's maintenance. It's how you stay disciplined and make sure your portfolio still matches your goals. But here's the thing. Even the best investment plan can collapse if you don't control the most unpredictable factor in the entire equation. You, the psychology of investing. Here's a truth most people never learn. Investing is 90% behavior and only 10% knowledge. Because the market doesn't just test your money, it tests your emotions. Fear and greed have destroyed more portfolios than bad investments ever did. Warren Buffett said it best. Be fearful when others are greedy, and greedy when others are fearful. Morgan Housel adds, doing well with money isn't about what you know. It's about how you behave. During the 2020 market crash, I got a call from a client who was panicking. He wanted to sell everything. We ran the numbers. If he sold, he'd lock in a 25% loss. So he stayed put. By 2021, that same portfolio was up 40%. That's the game. Investing isn't about winning every battle. It's about staying in long enough to win the war. And here's the secret to doing that: to keeping your emotions in check when everything feels chaotic. Build a plan that runs on autopilot. Automate your investing system. Here's the secret to consistent wealth building: automation. Automation turns discipline into default. When your money moves automatically, you don't rely on willpower. You rely on systems. Set your investments to go out on payday before you even see the cash. That's how the wealthy build wealth quietly in the background. Behavioral scientist Shlomo Benartzi found that automated savers end up saving 3 times more. Today, modern tools can help you automate. Most brokerages like Fidelity, Vanguard, Wealthsimple, Schwab let you auto-invest into index funds. Robo-advisors can rebalance for you automatically. Some apps round up your spending and invest the change. This micro-investing builds discipline. Visualize this flow. When payday hits, your money automatically moves to your investment account. From there, it's invested into your chosen index funds automatically. Once a year, you simply check in, rebalance, and you're done. That's it. No stress, no second guessing, just wealth building on autopilot. You set it once, and it runs while you live your life. Now you know the system. But how do you actually start today, without getting overwhelmed? Action challenge. Here's your mission this week. 1. If your employer matches contributions, hit the maximum match. That's a 100% instant return. 2. Open a tax-advantaged account. 401k, IRA, ISA, SIPP, RRSP, whatever fits your country. 3. Pick a low-fee index fund and set up automatic monthly contributions. Even if it's just $100 a month, consistency beats perfection. Recap. Let's go through the key takeaways again. Employer match is free money. Never skip it. Tax-advantaged accounts supercharge compounding. Diversify, minimize fees, stay consistent, rebalance. Automation removes emotion. Investing isn't luck, it's a system. Because if you don't have a system, you're not investing, you're just hoping. Here's the truth: if you're not investing strategically, you're still trading hours for money that never trades back. But the moment you set this system in motion, your money starts showing up to work, even when you don't. Because the difference between a gambler and an investor isn't luck, it's structure. Drop a comment with your next move. Maybe it's opening that first investment account, claiming your employer match, or automating your contributions. We'll reply to the top comments personally. Hit subscribe, turn on notifications, and join the insiders who are done playing defense with their money and are now building offense. Because saving keeps you safe. Investing sets you free. And in the next episode, we'll explore what happens when your money doesn't just grow. It works. When it keeps earning, even while you rest. It's the shift that separates people who stop working for money from those whose money starts working for them.